So today I'll provide an update on my sector ahead of reporting season. In terms of the key beat and miss candidates, I covered them a couple of weeks ago, but just quickly, I think Amcor has the potential to beat, given it's got a very good track record over the past 18 months throughout the pandemic, with 5 upgrades over that period. And I wouldn't be surprised if that the FY21 result or the outlook was once again ahead of market expectations. And then on the miss side, I think there's some risk around Endeavour, mainly on the back of the various lockdowns in New South Wales, Victoria and South Australia over the past few months, impacting the hotels business. Queensland is obviously currently in lockdown, and there's a chance that that could be extended beyond Sunday, and also Victoria has also gone into another lockdown as well. So this will all put some downward pressure on FY22 consensus earnings forecasts, but nonetheless, if you do have a longer term view, then I think Endeavour is a really good business, and if you do get some share price weakness out in the result, then I think it could be a decent buying opportunity. Onto the other stocks. So I might start with the supermarkets, Coles and Woolies. Obviously, both have been key beneficiaries of the pandemic with very strong sales growth over the past 18 months. But we should see a lot of that sales growth slow and probably be flat to negative towards the end of FY21 as both companies cycle the onset of panic buying and pantry loading from last year. In saying that, COVID looks like it's going to be around for a while, and that will mean more people staying and working from home. So I think both major supermarket operators will continue to benefit. From a sector perspective, still really positive. The sector, I don't think you can get too wrong with either Woolies or Coles, to be honest. But from a preference point of view, then I still prefer Coles, mainly on valuation. With Coles trading on about 25.5 times FY22 PE and a 3% yield versus Woolies on about 31.5 times and a 2.5% yield. Although with Woolies, just remember that there is likely to be a $1.6 to $2 billion capital return announced over the next few months and possibly as early as the upcoming result. Onto Wesfarmers, I expect Bunnings and Officeworks to deliver very good results on the back of the DIY and working from home boom, albeit similar to supermarkets. Growth is likely to moderate in the fourth quarter of FY21. Kmart should also perform well, and Target is undergoing a transformation at the moment, and that seems to be going well so far too. Obviously, Wesfarmers has recently made a bid for Australian Pharmaceutical Industries, or API, and that bid was rejected by the API board last week. I had a chat to Wesfarmers about that, and they still think their offer for API is compelling, and I think there's definitely capacity for Wesfarmers to make a higher offer, but at the same time, they don't want to bid against themselves, and they need API or the API board to engage and allow due diligence for the deal to progress. So, we'll have to wait and see how all that plays out. But if it does go ahead, it will provide Wesfarmers with a new growth opportunity in that health, wellness and beauty sector. The stock's on about 30 times PE with a 3% yield. I really like Wesfarmers. I think it's a great portfolio. It's got a great portfolio of businesses run by a very good management team. And it's also got a very strong balance sheet. But I do prefer to just pick it up a little bit cheaper, that's all. And hence the hold rating. But I think if it does, if you do get a 5 to 10% pullback in the share price, I think it's one that I'm definitely comfortable buying because it is a very good company. Onto Reliance, so another really high quality business. Very good management team, and you've got solid long-term growth opportunities from the ongoing penetration of push-to-connect products in the US and the UK. I think it'll be a good result. Reliance last gave a trading update in April, and there was strong Q3 sales in all regions, especially in the US. So I'd expect that positive momentum to largely continue, albeit it does look like the US housing market is starting to cool a little bit from those extremely high levels, from 6 to 12 months ago, which I don't think is necessarily a bad thing. But despite that slowdown, I think the US market still looks pretty healthy there. On valuation, I've got Reliance on about 24 times PE. And if you compare it to its historical average of around 22 times, it's actually not too far away from that. So I think at these levels, I think it looks, still really attractive, especially when you compare it to Reece, which is also a very good business. But Reece is on 55 times, and I just think Reece looks really expensive, and I'd much rather be buying Reliance. And then finally, I might just quickly mention Aurora, InvoCare, PWH, and Acro. On Aurora, I haven't talked about Aurora for a while, but I still think it's a really good defensive business. It's also got a very strong balance sheet, and it's just completed a $260 million buyback. Australasia, which manufactures aluminium cans and wine and beer bottles, that division's been going okay, but the main issue over the past few years has actually been the North America division, mainly on the back of tough market conditions and challenges with the rollout of the ERP system. The good news is that that ERP rollout, that's all been finalised now, and it looks like North America has finally turned a corner with a really good result in the first half, and management is expecting further improvement in the second half. And, the stock's had a decent recovery over the past 12 months, so, around these levels, I guess, it would be tempting to take some off the table here, but I do think it's a genuine hold, and if North America can keep improving, then I think that the share price can have a little bit more to run. For new portfolios, I still prefer Amcor in the packaging sector, but if you've got clients in Aurora, then I'm still happy to just keep holding, because I do think things are on the improvement in that North American business. Onto InvoCare. It's always a bit tricky with InvoCare because the result does depend on the death rate and also the average spend per funeral. But if you look at the provisional death statistics from the ABS, year-to-date death volumes to April are up about 1%. So that's slightly positive. But with lockdowns and funeral restrictions, etc., that's going to have a negative impact on the average spend per funeral. Longer term, I think InvoCare looks really interesting as borders open back up and migration comes back. We also have an ageing population in Australia, so I think the long-term fundamentals remain sound. But in the short term, it's going to be a bit volatile. The stock closed yesterday about $10.75, and we do have an ad rating and 12.60 target price on InvoCare, so it doesn't look too bad around these levels. But I think if you can pick it up around the $10 or below mark and have a bit of patience, I think it'll be a decent long-term investment. Onto PWH, I think it'll be a good result, but the stock has had a very strong run over the last 6 months, and it's up about over 60%, and it's well above our target price. So, around these levels, it's probably more of a hold, to be honest. I know it's probably tempting to take some off the table here, and I probably wouldn't sell any just yet, unless PWR or PWH is becoming too overweight in our portfolio, because I still think it is a very high quality business. It is a genuine growth company, and it will deliver strong double-digit earnings growth over the next 3 to 5 years at the least. But given the run that it's had, I probably wouldn't buy any more just yet. Until we hear what management has to say at the upcoming result. And then finally on Acro, really good little business with leverage to growing infrastructure activity, especially on the East Coast. It's also been getting some good traction in the industrial sector, and there's been some good contract wins over the past few months. Acro has just recently completed a $10.5 million capital raising, and those funds will be used for further growth opportunities. So I think it does show that the outlook is still quite positive for the business. The valuation is definitely undemanding. It's on 8 times FY22 PE with a 6% yield. So I still think it looks pretty good value. So in summary, still comfortable buying Amcor, Reliance, Coles, and Acro. A little bit cautious on Endeavour going into the result, but I think if you do get a sell-off on the day, I think it'll be a decent pickup. Reece, trading on 55 times PE, I think that's just way too expensive, and I'd much rather be buying Reliance. And then for the rest of my coverage universe, it's pretty much a hold going into the results.